Hello, and welcome to another edition of Minds on the Markets. In this groundbreaking series, instead of bringing teachers and students to the financial markets of the world, we bring those markets into the classroom. I'm on home turf today. My name is Steve Kussin, and as I've mentioned before, I report on education for WCBS News Radio 880. Today, I'm at the CBS Broadcast Center, where our guest is Jill Schlessinger, who's an editor-at-large for CBSMoneyWatch.com. Jill, thank you for being with us today. Let's start by your telling us a little bit about yourself and your background. When did you get interested in business and finance? And at what point did you segue into media and reporting?
Well, first of all, my dad was a trader on the floor of the American Stock Exchange for about 30 years, so it's kind of a family business. My first job out of college was as a commodities trader on the floor of the Commodities Exchange in New York, where I was trading gold, silver, and copper options. So you remember Trading Places when they were all going nuts. I was on that floor and did that for a few years, traded for myself, and eventually ended up leaving trading and going into investment management. And I was an investment manager, and I did that for 14 years, where I was certified financial planner, investment advisor, helping regular people reach their financial goals. And one of the ways that we used to get business is that we used to be on the radio and television, and it was a way to get some publicity. And as it turns out, I kind of liked that, and it was fun, and I seemed to be pretty decent at it. So after a while, I started doing that more and more, and when CBS was launching a new website called Money Watch, they asked whether I would participate, and I joined them. And so it's been, since 2009 when we launched, so it's been a terrific run here.
There's been much talk about companies going public versus remaining private. What are the reasons which would make a company want to go public? What are the advantages and the disadvantages?
The main reason companies go public is that they want to make money and they want to raise money. And the reality is that it's not just two people who are starting a business that are cashing out. There are a lot of early investors, angel investors, private equity, those who are putting money into a venture early on. And in order for them to cash out of that business, going public, selling shares to the public is a way to get that money out. And so one of the big advantages of going public is you make money. One of the big disadvantages is once you are a publicly traded company, there's a lot of costs involved, there's a lot of regulatory involvement, and there's a pressure that doesn't exist when you're a private company. When you're a public company, the earnings are being watched quarter to quarter. It's very difficult. And some people say that being a private company can almost be easier because you don't have to worry about the short-term earnings. You can be a much more long-term investment-oriented organization. So people, they have to weigh the choices. Many people going public, it's not necessarily the greatest thing. For lots of companies, it works out beautifully.
Jill, in your last answer, you mentioned several types of investors. Could you please describe each one for us?
When a company is growing, they need to get money from different kinds of investors. So sometimes early in the process, they might ask their family members. You know, when Mark Zuckerberg was first launching Facebook, he probably asked his dad and his mom to help him out. Give me a few extra bucks, I'll give you equity. You're an equity investor. There are more sophisticated investors, and it's called private equity. Private equity is taking an investment and taking money and investing it in a company and trying to help that company grow. And you're hoping that as a private equity equity investor, you will get that money back in spades down the line. So it's early investments that are used to actually seed the growth of a company, and the hope is that over the course of 5-7 years that those private equity investors, those early investors, will get their investment out at many multiples to their original investment.
Three letters have been bandied around in the newspapers lately. IPO. What do they stand for? What do they mean?
Well, an initial public offering, or IPO, is a way for a company to sell its equity to the public. So initial, first time, public offering. And what happens is an IPO is that the company takes a certain amount of equity, ownership in the company, and sells that to the public. And the way an IPO works is that you can work with an investment bank. You hire a bank to basically say, hey, can you manage this for me? Can you take me public? Or you can actually do something that's called an auction, where you don't really use a bank to sell the shares. You distribute the shares on a wider auction basis. That's what Google did, a Dutch auction it's called. An IPO is really a regulatory filing. You have to file with the Securities and Exchange Commission. All of your I's must be dotted, your T's must be crossed, because what you are doing is you are selling a portion of your company to the public at large. And the SEC is trying to protect the public and make sure the public has all the information necessary to decide whether any individual investor or group of investors wants to go buy that piece of your company.
Here's a question many of our students have asked. When a company goes public, how is the price set? $2 a share? $20 a share? $200 a share? How is that established?
Well, it's pretty easy to determine the value today of a company. That's just a function of the business that the company is in, how much money that company is making. But the hard part about pricing for the stock market is that you're not betting on today. You're betting on the future earnings of that company. So a stock that may be worth, maybe its actual assets on its balance sheet, the stuff it's owned, may be worth $2 today. That's maybe the book value. But it has the potential to earn in the future, so that can drive the stock price up. The way that the value is determined of a stock is so fascinating. It's supply and demand. It's what people believe the company will be worth in the future. It's earnings potential going forward, because most people aren't buying a stock for 5 minutes, they're buying it for years. So the price is determined by the business it's in, the ability of the company to make money, and the public's perception of how successful the company will be.
Let's take a specific case study, Facebook. The initial price was $38 per share. How was that set? How was that determined?
Facebook's valuation was determined by the investment banks that were working with Facebook, led by Morgan Stanley. They worked with Facebook as the corporation to say, let's look at all the numbers. How are you making money? What is the advertising revenue? What are the deals that you're making on the side from third party or from gaming organizations? Let's look at what that's worth today. Let's look at how many users you have. And let's project out into the future what we believe the company can earn going forward. They come up with a price, okay, that $38 a share, and that is the price at which companies like Morgan Stanley and the rest of the investment banks that are involved are going to take the shares from Facebook and then distribute it to other investors. Remember that an IPO, an initial public offering, is not just sold to individuals, it's sold to institutions, primarily to institutions, in fact. Most IPOs go about, let's say, 85% to institutions like a mutual fund or a pension plan or a large money manager, and 15% goes to regular old individual investors. In the Facebook case, the percentage that went to individuals was far higher, is actually 25%, while only 75% went to the institutions. But those folks are going to take those shares at 38, and they are going to decide as soon as that bell rings what they will do with those shares. Shares can go up, they can go down. The IPO price is not set in stone, it's just the price that we start trading at.
Apple's price per share has undergone major fluctuations. What accounts for those changes in price?
The fluctuation in any stock, and specifically in Apple, is a function of who's buying and selling on a given day. Why do you make a decision to buy a stock like Apple? You look at the fundamentals of the company. You look at what business it's in. You look at how much money they are making. You look at the future revenue and the potential, and you make a decision to buy it. Why do you sell it? Because maybe those revenue estimates were lower than you had expected, or maybe some bad news comes out. And certainly when Steve Jobs was sick, there was a worry that perhaps his successor wouldn't be a strong enough leader. A lot of people sold Apple as a result. I think that they were sorely mistaken when we come back and realize that Tim Cook is a fine leader. So the day-to-day gyrations of a stock, it's simply a function of buying and selling, supply and demand. There is no fair value for a stock. In many ways, stock is predicated on the oldest law of economics, and that is who's buying, who's selling, and what they believe is going to happen in the future.
American Stock Exchange, New York Stock Exchange, NASDAQ, other exchanges. How is it determined on which exchange a new offering will be listed?
Well, this is one of my favorite questions because my summer jobs when I was in high school, I worked as a clerk on the floor of the New York Stock Exchange and then as a clerk on the American Stock Exchange. So a stock exchange is the physical location where the trading of a security occurs. And these go back a couple hundred years. The New York Stock Exchange, the oldest exchange, and this was a place called the Big Board. And it was called a Big Board because they had a big board where they'd write down which stocks were selling and who was buying and what the price transaction was. The American Stock Exchange was sort of the smaller exchange. It actually is called the Curb, and it's called the Curb because they used to trade outside on a curb and down on Wall Street. And the NASDAQ is an electronic exchange. There is no physical place. You can go to Times Square in Manhattan and you can see a big sign that says NASDAQ, but there's nobody trading on a floor of an exchange. It's all electronic. And more, the business is being conducted on an electronic exchange, whether it's the New York Stock Exchange or the NASDAQ. Electronic trading has really taken over. It's a really interesting question because the exchanges are vying for your business. They want you to list their company on their exchange. So for example, when Facebook went public, it was the New York Stock Exchange going up against the NASDAQ. And which exchange the company picked had a lot to do with how well the exchanges marketed themselves and said what kind of support that they would lend, what kind of trading operations they have. In Facebook's case, they chose the NASDAQ, and they may reevaluate that in the future. They don't have to stay on one exchange once they pick that exchange to go public.
Let's talk about a particular case study, Facebook.
The first thing to learn is that an initial public offering is a very risky venture. So it's not just risky for the company, it's risky for investors. Facebook went public, it was at $38 a share. It shot up to $43 on the first day of trading, only to plummet down to $30 within a week. And what that tells you is there's a lot of euphoria around going public, which may or may not be justified in the end. The exchanges and the buyers and sellers of these stocks will ultimately determine what is fair value.
Generally speaking, does the stock market affect presidential elections more than presidential elections affect the stock market?
I'm of the belief that actually that politics has very little to do with the stock market. And I believe that we give too much credit to presidents and to administrations for stock market performance, and we probably give them too much blame for the same thing. And frankly, it's the economy that drives stock markets, the general, where we are in the economic cycle. And of course, politics can affect that if there's big changes in tax law or if there's big policy mishaps from the Federal Reserve. It can drive a lot of the economic cycle and certainly affect stocks. But I wouldn't get too caught up in what the stock market thinks about the president or the president thinks about the stock market.
Why has Europe had such a major impact on our economy and the American markets?
You know, the European Union was this large economic union that formed after World War II. But after that, we got into something called the currency union, the Eurozone. That's 17 nations came together and create a single currency, kind of to go head-to-head with the US dollar. What has happened in the Eurozone is that they came together saying, hey, here's all the great benefits of creating a common currency. But what they didn't do was contemplate what would happen if one country actually had a mishap. What happens if one country spends more than it says they were going to spend? And as a result, we have a currency union that was created that has a lot of downside risk that wasn't contemplated. So how does this affect us? Why do you care about Greece or Italy or Spain? We care about what's going on in Europe because the default of any country on its debts, they borrowed money from the public, they're going to pay that back. If they don't pay that back, that could negatively impact us because it would be felt in European banks. The shock of European banks could go overseas. Here, our banks would come under pressure. It's not so much that that Greece is going to take down the entire world. If Greece were to default on its debts, it's not a terrible problem. The problem is if Greece defaults on its debts, then the world starts to think, what if Spain were to default on its debts? What if Portugal and Italy were to default on its debts? And if they do default on their debts, the banks, the European banks that lent them a lot of money would get hit very hard. And then US banks that lent European banks, they would get hit very hard. And we're all connected through the banking system. The other part is that if Europe goes into a recession, this negatively impacts our economy. Look, we export a lot of stuff to Europe. They buy things from us. If they're not buying as much stuff from us, our economy is going to suffer, and the entire world is going to slow down as a result.
I'm fascinated by how the rate of exchange is determined. When I go to the airport, I see that rate constantly changing. How is it set, the rate of exchange between currencies?
Investors make a determination just like they would with every stock or every bond. And what's happening as the currency exchange rate shifts is a bet as to the economic soundness of a country versus another country. Now, right now, it's a funny thing that's happened. It's a great example. The US dollar is probably a little bit stronger than most people would have expected. Well, why is that? I mean, we've come off of a terrible recession, and yes, the value's gone down, but it is a bit stronger today than most had predicted. predicted. And the reason is there's so much uncertainty in the world that in many cases, in times of great panic, fear, and uncertainty, investors flock to what they know to be sort of the gold standard of investing. I'm going to go to things that are denominated in US dollars because the US isn't going to default on its debts. And taking it one step further, investors are even willing to lend the United States money for 10 years and only get back 1.6% in interest. Why would anyone take that deal? I'm going to lend somebody money for 10 years and only get 1.6% back for a dollar that could shrink in value over time? The reason is when I'm really worried and the world's falling apart, the best thing I can do is buy a U.S. Treasury, something safe, secure, even if after taxes, I'm literally paying the government to borrow money.
We're going to conclude with two questions I ask all of our guests. For our students who are considering a career in business and finance, what advice do you have for them?
Well, I think if you're going to go into business and finance, you should go in with your eyes wide open. The industry is changing dramatically. From 25 years ago when I entered into this business, it was not a flashy business. Nobody really knew what a trader did. No one had ever heard the term derivative. And it grew so fast and furiously. And I would say that today what's happening is the industry is shrinking and probably right-sizing. So before you jump into business or finance and you think it's a great way to make a lot of money, understand you are actually jumping into an industry that is probably shrinking and on at least ebbing for a while. That said, if you love it, if there's something that just calls to you, investigate all the different parts of this industry. It is a very different thing to be an investment banker where you're going to help a company go public versus being a trader on a floor or a trading desk of a big company versus being a salesperson. There's all different parts of business and finance. These are such different jobs. They also have very different lifestyles. So you should talk to people in these industries, friends of yours that you know. Go intern as much as you can. Go get those experiences and see what you like. And what you will like as an intern or even as a recent graduate is not set in stone. I was a trader and I did it for 4 or 5 years. It was great fun, but I couldn't see doing it for the rest of my life. So I really took a different track, and give yourself permission to take that different track.
Then what types of courses and majors would you recommend?
If I were to go back and look at my major, I think it would be sort of laughable. I was an international relations major, and I think I got enough credits to be an English major also. Totally not useful in the business world, but it was a great liberal arts education. There's so many parts of it that have helped me, and today, as being in the media, it certainly helps that I can write. If you are really excited about business and finance, some of the majors that are worth considering, of course, would be statistics, applied mathematics, economics. It is the hardcore math, know how to do those equations, and that will serve you very well. Had great advice when I had an early interview. Someone said to me after I was at a summer job, and a woman said to me, there's exactly 2 classes that every single graduate needs to have. One is Statistics 1, and the other is Statistics 2.
And finally, what advice do you have for our students who are interested in getting involved as investors?
I want to tell everybody that if I were going and starting all over and I said I could re-educate the United States public about investing, I would say throw out individual stocks. Only buy index funds that have no commissions, that are very simple, that replicate an index. So the S&P 500 is an index. There is a bond index. All of the research that has gone on in the last 25 years really points to something stunning. Picking stocks that beat their relative index, so picking a portfolio of stocks that beats, say, the S&P 500, is really hard, and so few professionals can do it that I would encourage everybody to say, let me throw out this whole stock picking thing and go back to the basics. Where do I have the very best probability of earning money over the long term? And that is with a low cost, simple index fund. And a portfolio built of simple index funds, variety of different index funds or exchange traded funds that replicate an index, that is a much better approach than trying to find what you think is going to be the next Google or Apple.
Jill, I want to thank you for being a guest on our program today.
Thank you very much for having me.
And teachers and students, I want to thank you for inviting us into your classrooms. For Minds on the Markets, I'm Steve Kussin.